Hello guys, welcome back to the channel, best place for long-term stock investors. Now, this week's quick dive, we're going to do something a little bit different. Basically, we'll be responding to the comments or the questions that was posted during our previous Stashaway video, which we posted in January. A lot of you had a lot of questions, a lot of Sammy hate comments, I would say as well. So we want to address directly as many questions as we can. We cannot answer all of them. There are hundreds of comments. So yeah.
For those of you staring into your trading screen and you're seeing red all over your portfolio and you're trying to figure out what are the stocks that potentially can recover with the Malaysian economy once everyone's vaccinated, we're doing a special session to uncover some of these stocks on the 29th of July, and you can find the registration link in the comment sections below.
Okay, John, first question comes from Mr. Hun. I hope that is your surname. I hope I got it right. Basically, he says that Stashaway provides diversification based on geography and asset classes, so gold and commodities. And it's similar to the all-weather portfolio. So for those of you who don't know, the all-weather portfolio is popularized by a hedge fund manager called Ray Dalio. He runs a fund called Bridgewater, the largest hedge fund in the world. And he's saying that if you try to pick, your own best stock, right, get ready for a lot of swings. So I think this question is divided into two. The first is about geography diversification, and the second is about asset class diversification. So what are your thoughts?
I think diversification in the word, I know it's very common belief that diversification is best for the investor, especially in terms of volatility reduction. But the reverse is true when you're too diversified.
Yeah.
So I'll give you an example. Let's just say you had a portfolio so wide that you invested in Japan, Europe, and US. And let's just say your Japan geographical asset actually went up. And it went up by, let's say, 100%. But because your diversification was so small, it only constituted 1% of your portfolio. 100% multiplied by 1, you only get a 1% gain. And I think that therein lies also the danger of diversification. Secondly, I would say that as a Malaysian investor, what is your circle of competence? And I'm speaking on behalf of our experience, investing in the local markets as well, MJ. You know the Malaysian market much better than you know the Japanese market. Unless you're probably from the industry, you look at economic data, you understand Japanese companies well, you understand the nuances of the Japanese economy. By handing over to someone who deems to be a professional, they also are at a risk. If they are based in Malaysia and they don't rely on local nuances to understand that market well, also it's just spreading your bets. That's how they safeguard themselves.
Yeah, and the thing I realized about investors, which I think is quite unhealthy, is that people like to invest in things that they actually don't understand. Somehow,
yes.
If they don't understand it, then the chances of high returns is higher for whatever reason.
And by abdicating it to someone else,
that's true.
Those people can actually help them mitigate and abdicate. To be honest, they're also humans. I'm not saying fund managers are they're also susceptible to things like COVID, to things like macroeconomic change, policy change by the government. They also it's not that they're not good, it's that there are certain things that are really beyond their control as well.
Correct. I totally agree. Now, specifically to his question about geography and asset classes, right? If you think about it, in theory, it sounds very good, right? Geography, you don't want to, you don't have country risks, right? People like to use the word. But the thing is, as you rightly pointed out, you may not have an edge. You don't know too much about these different economies. But as well as the evidence, especially, it all depends on your objective, I think, right? So if your objective with Stashaway is to store your wealth and preserve it and then grow at a slow but steady rate, it's slow, maybe not even as good as EPF potentially, we don't know because it's still a pretty young company. But if that's your objective, then I don't see a problem, right? Diversifying across many geographies or asset classes. But if your objective is to grow your wealth faster, especially a lot of people are young who are in our comments who use Stashaway, then that may not be the best case, because the people who do grow wealth really quickly, right, are the people who actually focus. So
that's correct.
Let me give you an example, right? I don't know who, and I should
Yeah.
have done my research, so I apologize to all of your researching. But let me tell you someone who's very focused. The founder of Stashaway. Right?
Oh yeah.
He's very focused on building one asset class, which is Stashaway, or the leaders or the CEOs or whoever's running the company. They are focused on building the asset classes, and Stashaway has done really well. They have 1 billion in Malaysia, worldwide. They have many more billions. So, that's how they actually grow their wealth a lot faster, not through diversifying across asset classes and geographies like gold and commodities. There's a lot more for me to say, but basically that's what I think. It depends on your objective. If you want to preserve and grow at a very slow pace, then Stashaway, I think, is a very good place to be, and very non-volatile because they try to reduce volatility. But if your objective is to really make that leap, then I think other options are a lot better. And being focused means that you develop mastery, and that's when you get higher returns. So any last words before we move on, John?
No, I think maybe you want to give an example. Can you try imagine giving diversification advice to property guys? So instead of focusing on a certain area, you try to tell these property tycoons, diversify across Malaysia lah. One in Kedah, one in Penang, one.
Imagine telling the boss of One Utama.
Yeah.
Right.
You should diversify to Sekinchan. You should diversify to in areas where they don't even have a master plan. They don't even have a sizable land bank. And then you tell them to diversify there. I don't think that is very smart advice lah. So those are my
the owners of One Utama only need One Utama, right? They just focus on that one thing. So
Yes.
All right, let's move on to the next question. All right, guys, before we move on, if you didn't know, we actually give free reviews for any of your stock analysis. Now, the key thing is that we've been doing this for a month now. We're getting really good reports. But some of you actually just send us and say, hey, what do you think of stock A? What do you think of Asia? What do you think of Genting and all that? What we require is for you to actually produce a report, and then we will actually analyze and tell you if you've missed out anything or there's certain angles that you should actually be covering in the stock. So we do that totally for free, but just make sure you put it in a report form. Okay, John, next question is by Happylicious. Very nice name, very nice photo.
Yeah.
So as someone who has no clue how to invest, Stashaway provides easy ways to get better returns than FD. With a bit more risk attached, but it's a lot simpler than self-investing. So her question is, does self-investing take a lot of time to perform better than average?
It really depends. But in our belief, it can be with proper training, because if you were to invest in Stashaway or an ETF-based asset class, right, what would you need to do as well? You need to do due diligence on the ETF itself. Study the fund, study the fund objective, study the previous performance, and then try to figure out the fees, right? So if you spend that same amount of time understanding businesses, I would argue that it would be almost the same amount of time lah. And the advantage is that you have full control. Whereas if you go to Stashaway, even though you study the fund, study the ETF, and study the allocation is not determined by you; it's determined by Stashaway. So you may. Yeah. I was reading some comments, MJ, on other people's content on Stashaway about they actually had comments and feedback telling Stashaway to go back into the US. Most recently Stashaway did a portfolio rebalancing.
Yes, correct.
Yeah, and then they exited US equities, and the comments was actually asking, please put back the US equities. So it also dawned on me that, it also dawned on me
actually, I'm going to address this point in another video. In another question later on. But keep going.
Yeah, so it's like it's really beyond your control, even though you studied all that. So what is within your control? I think that's the point I'm trying to come across. And you see, I think there's this belief, MJ. many people are being told that stock investing is difficult, leave it to the professionals and all that kind of thing. Sadly, sometimes those advice are given for certain vested interests.
Yep.
And I feel that empowerment and education of yourself, only you can decide.
Correct.
You know, you can either believe in that fear mongering, you can either believe in, or you can believe in yourself that you can actually are capable of understanding it. And I think that's where that mindset shift has to occur first before anything else.
Yes, actually. However, I would say that I do quite like Stashaway Simple. I don't personally use it, but I think it's great. It's a lot more flexible than FD. I would say that is probably their best feature for me, at least. But in terms of self-investing, taking longer time, well, it depends, right? Do you want to be in charge of your wealth, like you rightly pointed out? And do you enjoy it, right? I think the best place to invest is actually not whether it's an individual stock or a ETF or Stashaway. It's what can you see yourself applying effort and not complaining that it's difficult.
Not complaining is a task.
Not complaining that it's difficult or that it's a task, right? Because that's the thing that's gonna keep you going. Like for us, we like individual stock investing, so that's where we are now. In terms of in Malaysia, let's say, right, if you're using the ETF, I think that's one of the some of our friends actually market their ETFs, Malaysian ETFs, but they're not so good. So all the opportunities in Malaysia is actually in the small cap arena, right? It's in the individual stocks that you don't hear about a lot.
Yeah.
So that's why investing in Malaysia is a little bit different, because you need to understand the landscape. But
the struggle for that also, MJ, sorry to interject, but the landscape, why they don't go into, the Malaysian ones don't go into the small cap, is because the indexes are not available for them in a way. That's why one of the reasons. So
next question. All right, John, this next question is, I think, a big sticking point for a lot of the people in the comments. The comments that we put here are already the nice ones, in front of you. But basically, Patoises, I hope that's how I pronounce the name, he was referring to 11 minutes, 54 seconds in our previous video, saying that, the fact that Apple has high return than gold and silver proves that it's a higher risk investments. Higher risk, higher reward, lower risk, lower reward. This is the basics of investments. And then somewhat linked to this, and it has to do with volatility, is Miss L. I think maybe what they mean by risk is volatility. Gold and bonds are clearly less volatile versus equities. Equity will generate higher returns, but it's riskier, etc., etc. So, before I give my thoughts, right, John, what are yours?
I think too many people just take things at face value and take on academic-based kind of concepts. If you listen to a lot of successful investors out there, they will tell you volatility equals returns is actually quite rubbish. Actually, the real risk of investing is permanent loss of capital. And I feel that when people don't actually take the extra effort to really understand why, or to think why should volatility equals returns, right? I think they will get a better enlightenment. I think you will definitely explain this in your thoughts. Please.
Sure. That's the key thing, right? Volatility, guys. It's tempting to think that volatility is risk, right? Because volatility is just, there's a mathematical definition for this, but volatility in very simple terms is just how wavy a stock price is, how it gyrates, right?
Yeah.
How it squiggles, to use one investor's word, on your trading screen. Now, let's take Patoises and Miss L's question head on, right? And that is the fact that Apple has a high return and gold proves that it's higher risk investment. So let me explain to you this. If you inflation adjust, right, the price of gold has grown by 3 times over the past 100 years.
More than that, I think.
Yes,
was it?
100 years.
Yeah.
If you inflation adjust.
Yeah.
Apple is not even 100 years old. It's I don't know, it's like 50 years old right now. I think 40, 50 years old, something like that. I don't even want to count, right? It's like few 100,000%. So what I'm trying to say here is that actually at the end of the day, risk is not knowing what you're doing and also low returns. So this idea of low returns equal low risk, it's just false, right? Because imagine if you put your money in gold, let's say 100 years ago versus when Apple just started and, gold has a head start. It would be way riskier for you to put your money into gold versus Apple. And this just goes to show some of the issues with some of the rebalancing that happens in not just Stashaway, any robo advisors. Because what they're doing is they are putting their assets in low volatility, or whenever volatility spikes up for one asset class, they actually shift to something else, right? Now, Patorzi said that this is the basic of investments. No, this is the basic of the common understanding of
common
investments.
belief, street belief.
Common beliefs.
Yeah.
But if you watch our channel for quite a while, we are a bit uncommon.
Yeah.
So and here's the thing, right, John? You early on you mentioned in the earlier question that you saw in other people's content or in the comments that they were saying that, hey, why shift away the Stashaway portfolio partly away from the US stock market?
Yeah.
Right. And the reason Stashaway shifted was because volatility was increasing in the S&P 500, in the tech companies and all that.
Correct.
And so what happens? They move away. But if you think about it, if a company is good, right, whether it's your Apple, your Amazon, and Facebook, and volatility increase, i.e. the stock price starts to gyrate and fall down, let me say another basic on investment: buy low, sell high. Right? It is when there is volatility, is when actually, if the companies are good, the risk has actually lowered, because your entry price now is a lot lower than before. But if you use volatility as a measure of rebalancing your portfolio, it's not wrong. But what actually ends up happening is that you move away from high quality assets just because they're volatile. And that is the simple fact about the stock market. Berkshire Hathaway, which is Warren Buffett's company, one of the safest companies in world history, had their stock fall by 50% 3 times in its 50-year history. 3 times, 50%. A lot of people don't know it. So even a super low risk stock like Warren Buffett, a high quality stock like, sorry, not Warren Buffett, Berkshire Hathaway, is ultra volatile in certain periods.
50%, I think by 20% people get out already. If you
Exactly.
equate volatility to...
Correct. So imagine, right, if you had a robo-advisor and it is investing based on volatility, what's going to happen? When Berkshire Hathaway falls 50%, they get out.
Yes.
When the correct course of action is to get in.
Yeah.
So that, I feel, is the big weakness of using volatility as a measure of managing your risk. Risk is not knowing what you're doing and what we call permanent capital loss. Any final words before we move on to the next question, John?
I think the only one that I will add is the article Warren Buffett wrote about gold. For those of you who don't know, I think it's a fantastic article. I won't spoil the surprise for you. Just go Google Warren Buffett gold fortune. I do not know whether there's a paywall nowadays for the fortune articles, but Warren Buffett very clearly illustrates the utility value of gold, the price I wouldn't say volatility, the price demand for it, and he makes an aggregate comparison to enterprises and business value. And I think if you understand and grasp that concept, then I think volatility, you have some enlightenment on volatility against your return on capital.
Yeah, man, guys. And, just to end, right?
Yeah.
Whenever an asset class has ultra stable prices, that's when your chances of making money is actually very low.
Yes.
And risk to me is when you invest in something and you cannot make money out of it, or even a lot of money. That's why for me, fixed deposits are pretty high risk. because my gains are guaranteed.
In a
right?
way, inflation adjusted. You inflation adjust, that's the risk.
It's nothing. It's a negative. You get negative
Yeah,
returns,
exactly.
right? Yeah, of course, depend on your basket of goods, of course. But basically,
Yeah.
it's a negative return. And if you look at people again, I go back to my earlier point in the earlier question of: are you trying to build wealth or are you trying to maintain it? Because if you're
Or
trying
hedge,
to build wealth,
yeah.
you need to be in areas that are more volatile. So the stock market you think is a very volatile place. Another area is actually business, right? Business is another way, is another asset class in a way that is very volatile, but has that opportunity for you to build your wealth. Of course, that's it. It's about self-knowledge. It's about training yourself. It's about self-education, actually improving yourself, and then making mistakes, but making the kind of mistakes that really doesn't blow you away when it comes to investing or running a business. Okay, this next one is a very interesting one. We never shy away from comments that are against what I do or criticizes. So if you look at what Raymond said, you're indirectly promoting your own products. I'll be discreetly, right? Sour grape, but I'll stick to Stashaway, and I find Raymond thinks that it will give decent returns more than EPF, and is satisfied, which is great. Casey said something very interesting to us, which is that we are fear mongering, and the underlying point is that you want to push your stock investing and ultimately your mentorship and program honest opinion. Thank you, Casey, for your honest opinion. So I'll start first, and then John, you can go after that.
Yeah.
Okay, first and foremost, I'm not sure what you mean by sour grape, Raymond, because for us, we were just addressing some of the concerns or some of the parts about Stashaway that we think that personally we didn't like. There were parts that we also quite like. So I'm not sure what you mean by sour grapes. If it's giving you great returns more than EPF, then fantastic. Of course, the only thing I would take note of is that EPF, we do have a track record, and in fact, by law, they need to give you certain returns, right? EPF. So, but if you contrast it to Stashaway or robo-advisors in general, it's still, in my view, unproven. Happy to be proven wrong, because at the end of the day, I still think that companies like Stashaway, any robo-advisors are net positive for the world, for society. It's an option, especially for beginners, to start investing. So personally, I think Stashaway has done a great job, and they have 1 billion in assets under management. I hope they hit 2. I hope they hit 10 by the end of the decade or even faster. So again, Raymond, try to stick to our points about Stashaway and address it, rather than actually just say that we are promoting our own products or we are sour grapes and all that. Now, Casey didn't use the word sour grapes. She used fear mongering. Again, we do our best to present the facts that we understand that to be, and how we understand those facts. Underlying points we want to push. No, at the end of the day, we want to share our views, and if that, in a way, pushes you to be more like us, to be into stock investing, individual stock investing, and if you apply for our mentorship program, then that's good for you. But clearly, Casey, you didn't fall for the fear mongering, right? And if you look at some of the other comments, people who agreed with us, they just agreed with us, right? They didn't say, now individual stocks are better than Stashaway. In fact, many of them still hesitate because of the volatility, and that's totally fine. But again, just like Raymond, Casey, I hope you can address our points specifically, like some of the other commenters that instead of using words like fear mongering or sour grapes, try to stick to the points that we made in the video, and so we can address them directly. So John, any thoughts?
Yeah, Raymond, I don't think Stashaway comparison to EPF is an equal comparison. And I think I said this in a video we produced on EPF, where I actually broke down the portfolio of EPF. The reason why EPF, okay, so maybe for those of you who did not manage to watch, we put a link in the comment section or something. A big chunk of EPF is that they know there's always withdrawals. And because of that, a big chunk of it is in money market funds, more than 60% if memory serves me right. And only 40% or 30% of it is actually in equity. And Stashaway, if you go for a risk index of 36%, a majority of it is in equity. So how is that an equal to equal comparison when EPF is giving you 5% returns and Stashaway is, let's say, is giving you 10 or 12%? Because it's not it's not basket weighted the same. Unless you're comparing EPF is 90% equities and Stashaway is 90% equities, then there's an equal to equal comparison to compare the returns. Right? So
makes sense.
It doesn't make sense for you to compare EPF because the objective is different. It's a pension fund, regular withdrawals. That's why they have to keep their money market instruments very high. Whereas, in Stashaway, you have a choice of, if you want to make comparison, you should make comparison between Stashaway Simple and EPF. Right? Because then the asset allocation basket is more mimicking of that of a money market fund, which is a majority of what EPF's money is in. So I think, if you want to compare, make an apple to apple comparison. Don't just make surface comparison. That's my honest opinion. But
before you go move on, right? I just want to add this point about Stashaway as well, is that the returns might be higher, right? But
correct.
It's how you receive those returns.
Yes.
So like Stashaway, it's based on an NAV. So if you gain 30% in a year, then it increases. Then some years you have negative. Some of our friends, like this year it's a negative.
Yeah.
But EPF is consistent, 5, 6, 5, 6. So it's a bit different. I think that's where to adding on to your point, John, that comparisons are slightly unfair. Yes. Continue.
Yes, correct. So like for KC's one. We do sell stock investing and mentorship program. But if you really understand our underlying objective, is that we find that we want to build a community where there is a very big skill discrepancy. And the skill discrepancy happens because most people take in just what we call surface information. We want to elevate people so that you can be a better investor. Regardless, whether you do stocks, whether you do properties, is all about elevation of self and elevation of education. So I think, thank you for your honest opinion. But at the same time, if you are, it's like when you are empowered with knowledge, right, then you are less fearful of hearing differing opinions. And I myself, together with MJ, we consistently look out for anything that contrasts or proves us wrong. We are happy to be proven wrong with proper facts and proper facts and data sets, rather than just making an opinion. And the other thing about fear mongering, what is there to fear? Because if you're empowered, then you know how to maneuver and manage your own portfolio. It's not a in investing, it's really not about comparison to the guy next to you or the guy next to the left or to your right. It's really about benchmarking yourself. And the only way you benchmark yourself is that you are empowered to be a better investor. That's all I put in.
Great, man. I think that's a good end to this question. So next question. Guys, before we move on, remember to like, comment, and subscribe. Click on the notification bell so that you know when new videos come out fresh just for you. All right, John, next question is by Hisham. Actually, it's more of a comment. He says that, good review. Thank you, Hisham. I started Stashaway in August last year, so this is 2020 August, with a risk index of 36%, so this is the highest. And so far today, it has a profit of 12%. Congratulations. But like you said, like you guys said, good for beginners, yes, but maybe not for a long-term period. So, again, thank you, Hisham. For me, I think I brought this question up or comment because it's important for people who are investing in Stashaway to know that even if they achieve that promise, let's call it 8 to 10% that you can get through Stashaway, you're not going to receive it regularly. So some years will be 12%, some years will be -5%, some years will be 30%. And for me, you should not expect what we call zero down years. Years where you do not have any negative returns. Because the nature of the stock market is that for every 4 to 5 years of positive gains, you will have 1 year of negative gains. So you have to adjust that expectation. It's not a smooth 8, 9, 10, 12% like an EPF, where EPF is 5 to 6%, rain or shine, good economy, bad economy. Yeah, they'll reduce it, but it won't fluctuate like Stashaway. And so, yes, we do think that Stashaway is great for beginners who are starting out. But if you want something a little bit more, if you want to elevate yourself, then certainly we believe you should look elsewhere. How about you, John?
Nothing much to add. I do want to come from an angle of the risk index because most of the time when you invest, there are certain rule sets. And for those of you who are invested in Stashaway, spend some time to really understand how indexing works and how there is a difference in between passive and active investing, where passive investing actually looks at very much index-based, purely market cap, free float kind of weightage. And I think that's where if the markets do well in general, it follows the mean. If the market doesn't do well, then it also follows the mean. And there's no, how would I say, you are not rewarded for, you are just rewarded based on averages, market return averages, rather than getting the upside of companies that are not yet in the index, but then actually do well because of the rising tide in the economy. Let me give you an example. Most of the returns that in individual stock investing come from what we call very small base companies, and then they eventually be large cap. The problem is they are not part of the index yet. Whereas if you invest in ETFs based on an index rule, right? If you invest in Malaysia, you're only talking about the KLCI top 30. And those are actually mainly consist of all the GLCs, the conglomerates, the banks, and all that kind of thing. How likely, then the question I'll pause is, how likely will Maybank be a 10x from where it is today? That means 10 times the size of it today. And that's where, while you reduce in volatility, because you don't see, how would I say, the squiggly lines for a big market cap company, but then you also miss out on the growth that comes with a small base and going into a large base. I think that's where understanding the rules of how these ETFs actually deploy their money and the way of fund structures is actually important, so that you understand whether that 12% consistent returns, as you pointed out, will happen over the future.
All right, next question. Okay, this next question by Simple Fruits. What type of fruit? I think it's a honeydew based on the color. Yeah, let me know what kind of fruit. So, if a large sum of money is put into this app, this is Stashaway, is there a way to provide a bank portfolio to the bank if you want to apply a loan, let's say, and whether they want to look at the asset side of things? So correct me if I'm wrong, John, but I think banks are a lot more focused on the income side of things. They really want to look at your income and what's coming in, rather than how much cash you have. And my experience is that, not mine, but I've heard stories where, people have like a few 100,000 ringgit or millions in the bank, and their chances of actually having a higher, what we call credit score, i.e. the score that tells you whether you can get more loans or not, it's actually lower than someone who maybe only has 10, 20,000, but has been consistently paying his credit card, his car loan and all that. So yeah, John, what do you think?
Yeah, you're right. And ironically, showing your EPF statement, I think, will be more valued than showing a 100,000 Stashaway kind of account balance.
Yeah.
Because it's really, like what you said, it's really about consistency. They want to see whether for the lack of a better word, repayment behavior and income sustainability. Because
right.
Yeah, so like for example, some of my fellow colleagues who do insurance, they have money stashed away in a bank, but it doesn't count because they are deemed to have irregular income because it's commission based. And what they want when the banks actually look for credit worthiness is they see how consistent. Let's just say this month they make 20K, next month they make 5K, whatsoever, right? They want to see a longer history to see that consistency of payment or income base lah, rather than just a once off, because that once off can deplete. You have 1 million, but then your debt every month that you have to service is 100,000. It depletes off in 10 months. So it's more about that replenishment and that consistent cash flow coming in lah.
Yeah, income produces a balance sheet, right,
Yeah.
John? I think it's
Yes,
very true.
that's right. Yeah.
All right. So, guys, that is the end of this Q&A. There were a lot of questions that we had to leave out, not because we wanted to, it's because it's just time constraint. And a lot of them, just comments, so we didn't really want to include them. But if you enjoyed the video, don't remember to give it a like. Follow us on our social media. Come watch some of our other quick dives, and see you next week.